Good afternoon. This is Jim Perry at Perry Capital in Miami. Friday, the S&P closed at a record high. That makes it 6 weeks in a row of an up move. The low trade was March 30th. We are up 17% from that low and now stand at over 8% in total return on the S&P for the year. That's a very good sign. Why are we here? Where are we going? How do we get here? What are the key components of that up move? I'm going to give you three main reasons. Number one, relative stability in the Gulf. Number two, stellar corporate earnings. Number three, an economy which is on very solid footing. Starting with the Gulf, obviously, it's the most emotional issue. Relative stability, slight exaggeration perhaps. Point is, oil prices peaked at $120 a barrel on April 9th. That's the day the ceasefire agreement was announced, and oil is down 20% from that move. We closed Friday at $95 a barrel. That's a good sign. Another good sign in the oil market is that oil traders have put futures prices in oil, the back month numbers, at below $60 a barrel. Let's hope that those guys know what they're doing, but they kind of see where things are going and they're right in the middle of all this stuff. So I like to think that that's a pretty good metric. So I think that oil prices will continue to fall. And I think that some of the conflict and disagreements and belligerence will calm down. And I hope that we are closer to peace in the Middle East than we have been in a very, very long time. If that's the case, and I believe international investors do believe that, the stock market's going to keep going and the global economy will do very, very well indeed. So stability in the Gulf is one thing. Stellar corporate profitability is another. Q1 earnings growth rate for the S&P 500 is at 27.1%. That's the best quarter since Q4 of 21 during the pandemic stimulus era. The Mag 7 earnings growth rate is up 61%, and the 493 other S&P members, growth rate and earnings there are up 16.4%. And that's probably the most bullish number out of all of them, because that tells us that the economic strength and stability is broadening out to the rest of the economy besides the big tech. Let's hope that's true. I think it is. The price earnings multiple of the S&P 500 forward earnings is at 21. A year ago, it was at 25 almost. So, the S&P is actually cheaper now than it was. And what it tells you is that earnings are going up faster than prices. That's a very good sign. And speaking of prices, the Mag 7, or Mag 8 actually, because Broadcom's in there now, the Mag 8 has a market capitalization, get this, of $24 trillion. And that number is higher than all of the stock markets around the world combined. This is a big number. This is why the dollar is firm. That's why money is flowing into this country. You can see that interest rates are also very stable. The bond market message is stable to lower interest rates. The Fed statistically is still in easing mode. That's the first algorithmic green light that anybody gets. The Fed's still in easing mode, statistically, of course. But the point is that interest rates still are on the way down. And I think that's going to continue because inflation is on the way down. The oil price is going to go down. And if you look at 1 month break evens in the tip market, I'm a bond nerd. I started in this business as a bond trader, and I'm kind of a skeptic, and I look at bond market messages first and most closely. But 1 year break-even rates were at 5.3% a couple of months ago. Now they're below 3. So anybody that tells you that inflation expectations are rising kind of is talking their own book. I just don't believe it if you look at the numbers. And I really do believe inflation is going lower and interest rates are going lower. Furthermore, credit spreads are very benign, right? The private credit market, credit is a loan. Leveraged loans are outside of the banking system, and the demand for those loans is across the board at every endowment, foundation, pension, insurance company, sovereign wealth fund you can find. Believe me, I know these guys, I talk to them, and the demand for these securities are very firm. I do not think you're going to see a credit market problem, except for the poor retail investors who are bailing on this stuff because they didn't understand the risks. And that's not their fault necessarily. It's the guys that put these deals together. So I'm mad at them, okay? The bottom line is it shouldn't hurt most portfolios. Third thing is the economy. The economy is doing pretty well, man. It's an AI industrial revolution. It is being financed through Wall Street. It is being paid for by people who need income investments, and the government is also very much involved. In fact, if you talk to the people in the tech sector, they will tell you that the government investment in this area is a matter of national security. I believe that's true. The Industrial Revolution is just getting started. The economy is being driven by technology. It will continue to be driven by technology. There will be ups and downs. It's not a straight line, but I do believe that if you're over invested in the tech sector and you read what's going on and understand the different sectors that are doing well at different times, you're going to do just fine in this market. If you want to have any information from me about our asset allocation and our core portfolio, by all means, contact me. I'm happy to talk to you about it and we'll work something out. Okay? So have a good rest of the weekend and thank you for your time. Bye-bye.